Paul, welcome back to Wealth Talk.
Hi, Chris. Glad to be here.
I know it took 63 episodes to get you on, and now we're back within just a couple of episodes later. So,
I can't get enough.
well, today we're focusing on something different, and we're focusing on a type of life insurance which has definitely got some benefits for business owners and wealth builders. So, why don't we dive into what exactly is relevant life insurance?
Sure. Well, it's really a fantastic tool for business owners, uniquely for business owners. And though the name sounds a bit obscure, relevant life, the way I would describe what it does is really a director's or a key employee's death in service life insurance benefit, but it's specifically tailored for small businesses. And ultimately what you're doing is creating individual life insurance policies, but in a super tax efficient way, which on six different levels, and we'll cover that I'm sure in a moment, saves tax. So effectively you're getting the tax man to pay some of your life insurance premiums, which is pretty cool, I think.
Yeah. Well, I guess let's look at those six different ways then, and see just how beneficial this can be.
Sure, absolutely. So relevant life or director's life insurance, whatever you want to call it, is very, very similar. In fact, it's pretty much identical to a normal personal life insurance. It isn't a super complex, super fancy type of cover. It's really just the treatment of the cost of the premiums that make it unique, and the way that it's set up is slightly different. So in simple terms, really, a relevant life policy is a policy that your business, your limited company, would take out, and the limited company would be the owner of the policy. Okay, so the policy is created by the business, and it's set up against a person which would be called the life assured, and they are the person on whose basis a payout would be made if they passed away. So the business owns the policy, and because it owns the policy, it pays the premiums. And the person who's covered is the life assured. They are the person whose family would be benefiting from the proceeds of the insurance if they were to die. Okay, and that would typically be you, the director of the business, or another key employee, perhaps part of your executive team if you have a slightly bigger business and you're looking to provide benefits to your employees. And the biggest benefit, and the first of the six tax savings where relevant life is concerned, is that because the policy is owned by the business, it's a genuine tax deductible corporation tax expense. So your first tax saving in the six tax savings that I mentioned a minute ago is that corporation tax. Mm-hmm. So today, as we're speaking right now, 19% saving on your corporation tax, because the cost of those premiums are tax deductible, which is pretty amazing. So even on a like-for-like basis, and you've got that immediate cost saving compared to having a personal life insurance policy.
Pretty cool.
Yeah, pretty cool. That's just one. So the next one is really a tax saving that's relevant to the director or the employee who's had the life insurance policy taken out on their behalf. Remember, the company is the owner of the policy, the owner of the premiums. But when you have benefits paid for by your company or by another business that you work for, very often they will attract something called a benefit in kind tax, which is basically HMRC's way of collecting tax on something that isn't paid to you as money, but is paid to you in some other form. And very commonly that would be, a company car, but it's also life insurance. And sometimes you would have a life insurance policy created by your employer, or sometimes if you're a business owner and you want to try and run your own insurance premiums, your own personal insurance premiums through your business, if you did that, they would attract a benefit in kind tax. And that means you'd basically be paying income tax and national insurance on the value of the premiums. Well, relevant life is exempt from benefit in kind tax. So you, the person who's getting the benefit of the life insurance policy paid for by the business, don't then have to pay that benefit in kind tax. So there's super tax saving number 2.
Great. As if any tax was kind, hey?
Well, exactly. Yeah, that's brilliant. I like that. Yeah, absolutely. So, the benefit to the person with the premiums is they're not suffering that benefit in kind tax. But that then takes me on to tax number 3, or tax saving number 3, I should say, which is employers' national insurance. So in the same way as the person who's getting the benefit from the business would typically be taxed, the employer who is providing that benefit must also pay national insurance from the employment perspective. So in the same way as a salary that is paid from a business, depending on how much is paid, attracts employers' national insurance, which is roughly about 14%. That would also occur if you had benefit in kind payments. But again, because relevant life sits in that really unique, specific part of the tax rules, it's exempt from employers' national insurance too. So there's another huge tax saving there.
Going well so far.
Yeah, so those 3 are, I guess, immediate tax savings in your life today. The next 3 are more about tax savings either for your loved ones in the future or for you later on in life. Okay. Number 4 is inheritance tax. So, on some level or another, most people are wanting to pass on a legacy down to their family. Of course, they want to do it in a tax efficient way. Nobody wants to pay more tax than they need to. And it's very easy to not quite get everything wrapped up in a neat tax efficient bundle and ultimately trigger some kind of inheritance tax liability somewhere down the line. Well, with relevant life cover, your policy is written into a trust from the day it's created. And is it worth just having a very quick segue on trust, just to kind of,
let's do that. We can definitely point back as well to some previous episodes, but for those, perhaps they're still not quite sure exactly how trust works, that'd be useful.
Okay, so quick 30-second overview then. A trust is basically a legal document which ring fences and protects assets or cash. And it's used for a number of reasons. Trusts have been around for hundreds and hundreds of years in England and in the UK, but predominantly they're used to protect assets and protect cash for future generations. And one of the single biggest benefits of a trust is that it ring fences, it pushes outside of your estate the asset or the cash that you've placed into it, which means that it isn't accessible for inheritance tax. Now, life insurance, with barely any exceptions that I can think of, should be written into trust, because it immediately then protects that benefit for your loved ones for forevermore. Relevant life is automatically written into trust when the policy is created, meaning there's no danger of that money accidentally creeping outside of the trust and going into an estate and therefore potentially becoming taxable somewhere down the line. It's wrapped up in that neat tax-free bundle from day one. Okay, so you're automatically protecting not necessarily a spouse or a partner, but possibly children further on down the line from a big inheritance tax bill.
Right.
Tax saving number 5 is still broadly the same point, but it's thinking about the way that you can then use that trust with the money that's been paid out from the life insurance. Unfortunately, we've had to kill you off for this example, Chris, right? But if that's okay, we'll imagine we've created a policy for you. Something tragic has happened. The life insurance has paid out. The trust has collected that benefit. It's done the job it was designed to do, which immediately keeps it out of the estate. Now, if that trust is then managed properly for the people who've ultimately inherited it, your next of kin, they can access the money from that and use it for whatever they want, paying off debt, buying assets that produce income, which of course very much sits with, huge theme of wealth builders, of course. And frankly, they can use it for anything they want. But if a trust is used properly, it has I guess what you'd call a rollover effect for future generations, because you can actually use that money and that trust to reduce inheritance tax even further down the line for other people. So let me explain what I mean by that. If you can imagine the money's in the trust and your partner wants to take some money to pay off the mortgage. Well, that would be logical. That's one of the main purposes that people want family protection and life insurance. But let's imagine that instead of just taking the money and it being discharged to your partner, instead what she does is she borrows the money from that trust. Okay, and there's a proper agreement drawn up between the trust and between her that says, the money will be loaned. It will be loaned for her entire life. It will not attract the requirement for a repayment until the day she dies. But an interest will be charged each year for the duration of the time that she has that money.
And who decides on that? Is that the trustee?
Yeah, it would be the trustees, and typically that would be your partner and possibly some other people. And you, as the person creating the policy, would get to choose who you'd want your trustees to be from day one. So again, a separate topic, but it's important to choose trustees that will have, your loved one's best interest at heart. And of course, they themselves can be a trustee too. So let's imagine, going back to that example then, that your partner's got the money and she agrees this repayment-free but interest accruing loan. Okay, and let's just imagine, for the sake of an argument, it's 5%. It doesn't matter, but let's just imagine it is. So the loan is made, your partner uses that money, she pays off the mortgage, she does some other things, the money gets spent and distributed, and then hopefully many years down the line something happens and she passes away. Now what actually then happens is that money is a debt that is owed back to the trust. And if you remember, that 5% interest has been accruing and accruing and accruing year on year on year on year. So not only does her estate, which remember in many cases is tax assessable for inheritance tax, her estate not only owes the original money that she borrowed, but it also owns the 5% of compound interest year on year on year on year. So if you think about what that's doing, it's actually reducing the value of her taxable estate, because it's taking a chunk of value out of her estate that is rightly legally owed back to the trust. The trust itself doesn't have to worry about taking the interest during her life, because it's got that agreement in place, but it wants it on the day she dies. So a big chunk of money goes back to the trust. What that's actually done is dramatically reduce the value of your partner's estate, and therefore the chance of her paying inheritance, or her family, her loved ones paying inheritance tax on that money is, either reduced or perhaps even eliminated altogether.
I get it.
Which super powerful.
It is, and I'm sure people are thinking now about different scenarios, and we'll have a lot of questions about that.
Yeah.
But I'll let you finish.
Yeah. Okay. All right. So those 4 and 5 are all about inheritance tax. Okay. So tax saving number 6 now, and this one is particularly valuable and important for people who have bigger pensions in their life, because a lot of death in service policies that are created through traditional employment are done in such a way that means that they are assessed on the day of your death along with the value of your pensions. And there's something called the lifetime allowance, which is really, I guess, a glass ceiling, but nonetheless a limit on the amount of money that people can have in their pensions, and before they start to have some tax paid on some of it. Lifetime allowance is super complex. Very happy if we could have a whole podcast on lifetime allowance easily. So without losing track, I guess it's really, at the moment, it's about £1 million, £1,070,000-ish, something like that. And over and above that amount, there is sometimes a tax to pay on the difference. Well, if you've got a big death in service policy with your employer, then that value of the death cover that pays out on your passing away is added to the value of your pensions. And if that pushes them over this threshold of £1 million and some pounds, you're then getting taxed on that. So even though you've done a great thing by having life insurance set up to protect your loved ones, the tax man takes a big chunk of it, and we know how hefty the tax on death, on inheritance is, 40%. So an enormous chunk of that money that you've set up and thought will be there and available for your family could be swallowed up.
Every opportunity, hey, they take.
Mm-hmm. Yeah. And, there's people sometimes call the lifetime allowance a stealth death tax. And actually, in truth, it is. But back to relevant life, because of its uniqueness, because of the way it's set up, does not fall into the lifetime allowance. So if you have big pensions or you're coming close to the lifetime allowance, and definitely if you're in excess of the lifetime allowance and you've got a death in service policy through your employer, relevant life could be a way of mitigating that potential lifetime allowance tax in the future.
Wow. Okay. The compounding effect there is pretty impressive. And why is this not so well known, Paul, necessarily?
Well, that's a great question. And I suppose, like all good wealth building tools, it needs people to shout from the rooftops about it because it isn't mainstream. And I guess the reason it isn't mainstream is because it isn't available to everybody. It's only available to genuine business owners. And there does have to be a proper employee-employer relationship. So unfortunately, sole traders can't have relevant life. Partners in a partnership can't have relevant life. It's really mainly for limited company directors and LLPs, where there's a formal company set up and then there are employees. Even if those employees are the directors, that doesn't matter. Mm-hmm. Mostly it is directors taking relevant life cover.
Okay. And what about the cost? How does that compare to a regular life cover?
Well, that's a great question, and you might be surprised to hear that it's exactly the same.
Wow.
So if you lined up £100,000 worth of bog standard personal life insurance with £100,000 worth of relevant life, the gross cost before any tax reliefs is exactly the same.
So my next question, where do we get this from, Paul?
Well, unfortunately, it's not something you can take off the shelf. And in a way, actually, that isn't necessarily such a bad thing. So with standard life insurance, you can go to a financial advisor or you can go directly to an insurance company. And we all know the big names, the household names that probably provide household cover, car insurance. They also all provide life insurance. Relevant life is a bit more niche. All the reasons we've just talked about make it a bit more niche. And because of that, it's not something you can get directly. You do need to seek that professional advice and guidance from a qualified financial advisor to make sure that you're setting it up, because there are a couple of rules. There are some limits to how much you can take, which kind of links back to salary or drawings, but it does need to be set up and created by a financial advisor. It isn't something you can go directly for. That's the only downside of relevant life. And I guess that isn't really a downside. It's just a stipulation.
Sure. And if, of course, anyone wants to find out more, then WealthBuilders can help and they can get in touch with us. Yeah.
Absolutely.
Okay,
yeah.
Great. Well, look, that has been so helpful, Paul. I'm pretty sure many of our business owner listeners will be, really strongly considering this as an option now. And why wouldn't you? Why wouldn't
well, absolutely. They definitely should be, and even if they're not pushing their own personal insurance premiums through their business, which can be done, but really isn't a very tax efficient way to do it at all. Even if they're just paying life insurance premiums themselves personally, 3 or 4 of those 6 tax benefits still apply. So you're still making the corporation tax saving. You're still making the inheritance tax saving, not just for your immediate family, but for multiple generations down the line. And of course, the lifetime allowance point is still relevant too.
That's brilliant. Well, Paul, you dropped the bombs on the last episode with the pension control. You've done the same again today, so we better start planning your return pretty quickly.
Well, honestly, I love these sessions, Chris, so I'd be delighted to come back. Really happy to do that. Thanks for having me.
Thanks, Paul.
Cheers, Chris. Bye-bye.